7 steps to take for a successful mortgage refinance. Refinancing your mortgage can be a great way to save money and reach other goals. Some of the steps are the same as when you applied for your original mortgage, such as submitting documentation and going through an appraisal. Here are 7 tips for navigating the refinancing process and getting the best deal possible. 1. Know what your refinance goals are. When you refinance, you have several options for term lengths, interest rates, and types of mortgages. Your decisions will depend on what you want to get out of the refinancing process. 2. Decide which type of refinance you want. Once you understand your goals, you can move on to deciding which type of refinancing is best for your situation. For example, maybe you have an FHA loan and your goal is to get a lower rate, but your home hasn't gained much equity and your credit score isn't great. In this case, you'll want to do an FHA streamline refinance. 3. Figure out how much equity you have in your home. Your home equity is the relationship between how much your house is worth and how much you still owe on your mortgage. If you owe $100,000 on your mortgage and your home is assessed to be worth $180,000, then you have $80,000 in equity. It's important to know your equity percentage. An easy way to figure this out is to calculate your loan-to-value ratio, or how much you still owe versus how much your home is worth. 4. Check your credit score. If your credit score has remained steady or improved since you got your first mortgage, you could get a good interest rate. A poor credit score might not keep you from refinancing though. If you have an FHA, VA, or USDA mortgage, you can streamline refinance into the same type of loan without pulling your credit score. 5. Get quotes from multiple lenders. You can refinance with the same lender you used for your original mortgage, but you don't have to. It's a good idea to get quotes from 3 or 4 companies so you can compare interest rates and closing costs. When comparing quotes, be sure to look at the annual percentage rates, APRs, not just the interest rates. APRs the interest rate plus the costs of things like discount points and fees. This number is higher than the interest rate and is a more accurate representation of what you'll actually pay on your new mortgage annually. 6. Factor in closing costs. Just like when you bought your house, you'll pay closing costs when you refinance. Typical refinancing closing costs are 3% to 6% of your principal. According to the Federal Reserve, that's $3,000 to $6,000 for every $100,000. After estimating your closing costs, think about whether it will be worth it to refinance. You might not be able to pay that much at once, or if you move in 2 or 3 years, you could spend more on closing costs than you'd save with a new rate. 7. Prepare for a home appraisal. An appraiser will assess the value of your home when you refinance so the lender knows your loan-to-value ratio. The more your home is worth, the better. Consider cleaning the interior and exterior before the appraiser visits and maybe adding a fresh coat of paint. If home values in your neighborhood are increasing, you could track down the data and provide the appraiser with a document. Increasing home values nearby usually make your home worth more. Understanding all your options when you refinance and preparing accordingly can make the process as smooth as possible. It could also save you money in the long run. Thank you for watching, and please don't forget to like and subscribe to my channel.